Miles, as I just mentioned, I was literally looking at the bond market yesterday and trying to find out if I was better off to buy a corporate bond of some sort versus even just a GIC. And I'm not really sure I am. And it's because the rates have been so range bound. And to your point, I almost think they're going to be a little bit range bound in 2025. Am I wrong? Or where do you stand in the fixed income market right now to make money?
Well, you point out that bond yields have kind of traveled in a, let's call it, a little bit of a volatile sideways action for the last while. And when you look at
Mm-hmm.
bond yields relative to their history, they're still sitting at the higher end of, say, the last 10 to 15 years. So it's not hard to find, if you've been a bond investor over like I have over the past, say, 15 or so years, it's not hard to find yields north of 5% without taking very much duration risk or without taking very much credit risk. So I'd say that the yield levels, the running yield in bonds is pretty attractive versus the last, say, let's call it again, 15 years. Do I see
Hmm.
huge upside in bond prices? I'm with you. I don't. I do think that yields stay a little stickier at higher levels, which I think is actually pretty good for bond investors because you get the running yield that's there, and the best predictor of future returns in the bond market is current yields to maturity. And so you're saying, if you can get 5% in a AAA corporate bond, AA corporate bond, 5+%,
Mm-hmm.
that's kind of going to be your annualized return over the next while. And so I think that's,
Yeah.
if you look back in time, that's pretty healthy.
That is pretty healthy, actually. That's a good point. And certainly some of these bond funds, even just the kind of the ETFs, haven't performed that well. I mean, I think they've been a little bit all over the place, but maybe just looking at the specific corporate bond, issuance is maybe the way to do it. Would you
Well,
agree?
the one thing about the bond market is prices do fluctuate and returns do fluctuate, but you know that for most high quality, let's call it almost all high quality bonds out there, they're going to mature at par, and you're going to get today's yield to maturity over the life of that bond. So, as
Hmm.
a patient investor, you don't have to be
Yeah.
as trading oriented in the bond market as you did when yields were close to 0% almost everywhere. Now you can kind of just
Right.
sit in that, be patient, and rake in 5%. If it's a maturity of 5 years or 3 years,
Yeah.
and you get 5%, you're going to generally get about 5% over the life of that bond. So there's no need to sort of look at your portfolio every day when it's marked to market the bond price, and you're going, "Oh, this return or that return," because the total return through the life of that bond is going to be what the yield mature very close to what the yield maturity says.
Hmm. That's a great point. I think it's important for people to understand this as well. Certainly, when it comes to bond trading, you need to be an expert in that area for sure. Miles, give us your sense right now as it relates to asset allocation, looking out into other asset classes like commodities, like real estate. What's your view?
So, when you're thinking about balanced funds, it used to just talk about stocks and bonds, but I think the Canadian government has made some regulatory changes over the last, I think it was 5 years ago now, where they've made it easier to access alternative investments for retail investors or for Main Street. So I think you have to consider stocks, bonds, and alternative investments in your portfolio today. All three are very important pillars to build a very robust portfolio. And if you're thinking
Hmm.
about uh, gold, would be considered an alternative as an example, done very well. I think gold is an important holding in a multi-asset class portfolio, but there's also all sorts of other types of alternative investments out in the marketplace today that will help the performance of your portfolio, including things that are, let's call them, directionally agnostic to the market. The direction of the market, either the stock market or the bond market, doesn't matter. And these are often things that go under the name of long short types of strategies, long short credit, long short
Hmm.
equities. And again, what you're trying to do with this alternative sleeve, which I do really think alternatives are important. What you're trying to do with this alternative sleeve is add another source. Let's call it an independent source for returns. And again,
Hmm.
that just helps your portfolio weather future economic and financial market uncertainty better.
Hmm. Absolutely. With respect to gold, even though it's had such a run, what do you do with it if you don't own it? Do you
You hold
buy
it.
it?
You hold it. you hold it, Catherine, or if or buy it. Look, I don't know that the near term direction of the gold price. It's just really hard to know. But I know through our statistical analysis that holding a little bit of gold in the portfolio over the long term does generate diversification benefits because it does act a little bit differently than stocks or bonds. So gold
Okay.
bullion, own it.